Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. And I think over the last 2 or 3 months, the monthly data point that has at times surprised most people and for the believers has made them stand vindicated are the real estate monthly sales numbers that come out from various agencies like Knight Frank, Anarock, what have you. And I think the numbers month after month tend to show some of the premium pockets doing really well. At the same time, the clamor that we hear is that affordable real estate is the one which is doing well. So it's best to try and juxtapose both of these trends or the differences, if you will, within these trends, and then try and figure out from somebody who looks at the equity end very closely about what are the markets that he believes could do well going ahead and what are the players within those markets which may do well too. Murtuza Arsiwalla of Kotak, he needs no introduction really, and he joins us right now on the show. Murtuza, great having you. Thank you so much for joining me.
Thank you, Neeraj. Morning. Sure. So, I mean, the point that you made on, premium segment versus affordable, I mean, there are two things sort of happening in parallel. One, you have a large wealth effect sort of kicking in. The stock markets have been on a tear for the last 12, 15 months. And, if you were to draw parallels from previous sort of bull cycles, there is a tendency of that wealth effect sort of spilling over onto the real estate market. It did help that, specifically in the state of Maharashtra, you had the government give certain fiscal incentives, and that did push sales. Also, in general, given the the nature of the last 12 to 18 months, where people have sort of been living more indoors than out and about, I think the value, the soft value attached to a larger, more premium apartment has sort of increased. So that's one part to it. The other part really is that, if you look at housing loan rates, they are at historical lows. Sort of most of us in our lifetimes haven't seen housing loans at these levels. That has encouraged people to sort of, fence sitters to cross over and say, this is probably a good time to actually invest in that house. While real estate prices haven't, the underlying housing prices, let's call them housing prices, lest we confuse them with real estate stocks. But the underlying housing prices haven't seen sort of a runway move. They are sort of within range, but there is a belief that you could, given the way the cycle's turning for the better, there would be an element of price inflation, which has been absent almost for a large part of the last decade. And that also sort of gets, the fence sitters to act in terms of their housing decision, moving away from a rental to a purchase kind of a decision. And it's a combination of these factors. Clearly, near-term headline numbers also sort of bumped up by the fact that you've had, some very long periods of lockdown, which did inhibit transaction activity, right? So even that's sort of playing its part. So it's a combination of strong underlying sort of demand, which is always there, pushed a little more by the potential price increase, low interest rates, as well as the fact that activity levels were low. And so there's an element of pent-up demand. So it's a combination of things that's playing out. And
Sure.
Developers across the board, if you speak with them, they're not complaining.
I'm sure they're not complaining. It must mean a lot of work for all of us who are tracking the space closely, Murtuza. But let me try and pick up individual pieces one by one. Let's say the commercial demand first, and then I'll come to residential because that's the larger piece. Commercial demand, the belief obviously was that work from home or work out of office is a trend that might continue. In some industries, it might still continue. Arguably in your and mine industry, it is still continuing to an extent.
Yes.
Does it have an impact on a material impact on office occupancies and thereby office rentals and therefore companies which have got a very high commercial portfolio, would they be viewed, less favorably than a larger residential portfolio company?
So if you look at the stock markets and the way they've viewed them so far, if I were to specifically look at the performance of REITs, they've clearly lagged those of other sort of players. The headline numbers on commercial real estate, they have been lukewarm. They've been far from exciting, to say the least, but it's not been a washout. So if I were to take this discussion back, let's say 12 months, the fear was that it will be a washout kind of a number. The reality today is that the acceptance is the reality is somewhere in between. It's not going to be an extreme form of work from home. It may not be an extreme form of coming to office. The balance will be struck. And again, what is the actual quantifiable impact? Really, you will get a sense of that once people start moving to office. However, besides the adoption of work from home, one also needs to consider what is the underlying growth of the business. For instance, IT as a sector has been doing fantastically well, right? Hiring numbers in the IT sector has been fantastically well. So in the last 24 months, even if you may have an increased adoption of work from home, it could be offset by the underlying business growth, right? That's part one. Part two, the way you want to think of it is how the adoption of work from home will take place from a sector to sector basis. So you could have companies which will say, okay, my employee can work from home, but I need not keep a hot desking facility. So I continue to maintain a dedicated desk for him. That will really be a function of what is the kind of revenue per employee that you're looking at. So there will be sectors which will be more frugal and more cost conscious. And then there will be sectors who will say, I'm giving you the work from home, but there's always a desk in office. So to be able to quantify the impact, even at this stage, is hard till we actually move back to office. But having said that, I think a general acceptance is it's not going to be as severe as was originally envisaged, number one. Number two, it'll be cushioned by underlying business growth. And in my view, just like you saw a pent-up demand on residential sales, you could see a similar trend maybe a quarter or 2 quarters down the line on commercial once people start moving back to office.
Okay, so maybe that is something that is not quite priced into some of these players.
Absolutely not. Absolutely not.
Got it. Okay, now let's shift right out to the big fish, which is residential. Too many markets, too many micro markets within that, and too many players having different or varying models, so to say. Murtuza, what has impressed you the most in the last 12 to 18 months when you look at the strategies and the sales of varying players?
I think what's impressed me the most, if you look at the leading real estate players, they've not let their shoulders drop. So we understand their challenging times. We understand that it's harder to close transactions, but they have, even in the quarter of the lockdown, be it, if I were to look at March to June 2020 or even, March to June 21, the sales have been there, right? There have been reasonable numbers in the backdrop of a physically restricted environment. I mean, something like a DLF doing about 10 billion of sales in a quarter where, the National Capital Region was severely impacted was definitely standout impressive, right? The fact that a large part of that sales came from, premium properties like the Camellias was definitely impressive. So there have been definitely notable achievements where at the start of the pandemic, the market belief was all's lost kind of a thing in terms of these lockdowns. But a large part of that business has been salvaged by the players, and the adoption of new technologies, new mediums, getting things done was definitely impressive and stand out. Clearly, the organized players have gained disproportionately relative to the sector. So when I look at the organized players, they have been able to do record sales over the last 12 to 18 months, sales that they were not able to do even in a pre-pandemic period, saving, of course, the peak lockdown sort of quarters. And that's impressive. And that tells me, the reason the market's sitting up and taking notice is the consolidation theme that you and I, have been talking about for some time, industry participants have been talking about for some time, suddenly finds acceptance by the investor fraternity. And that's what's really the big change that's come about as far as real estate stocks or investing in real estate goes.
Oh, excuse me. Murtuza, would you believe that in a scenario of probable higher sales industry-wide, we'll also have the scenario of maybe some of the sales which erstwhile would have been catered by a lot of fringe and small players, or low quality players, if you will. Also, some of them will go away, not all, and they'll be absorbed or they will move to the organized players because people will want to put their money behind a trusted brand, delivery project, etc., etc. Do you think that is what will happen, and therefore would the console sales of some of the recognized players, and a lot of them are listed by the way, would naturally show an uptrend, and because of consolidation they'll show that added bonus to their sales? Is that a possibility?
I think that's absolutely, I would say it's more than a possibility, closer to a certainty.
Certainly.
And you're beginning to see that even in customer behavior, given what we've been through over the last few years, not just the pandemic, you've definitely had a lot of developers who've not been able to deliver on promises, without sort of taking specific names. The newspapers filled with sort of developers and regulatory cases, etc., being pulled up, developers being pulled up by various regulatory authorities. That is a reality. And consumer sees that, and he's having a natural drift towards the organized, in our case, the listed players. And so if most of the consumer is sort of gravitating towards organized players, needless to say, they will have a larger share of the pie, and that added bonus that you're talking about, it's already visible in numbers. The question the market is asking today when you look at stock prices is, how much is that gain really in market share? And that's what sort of keeps me scratching my head most of the time as to how much more can they do, while we are in acceptance that they would do a lot more.
So are you at the liberty to talk? I mean, I don't want you to give us a recommendation of what stock you are recommending to your clients to buy, but which of the companies do you reckon have some of their incremental future positives in the price by virtue of the move they've made? If that is a difficult question to answer because it involves that, maybe you can tell us about which of the companies you believe have the potential to grow their sales multifold over the course of the next few years.
So I'll be more generic about it, and the reason is that's the way we viewed the sector. So it's not, my what I'm going to say is pretty much aligned to what my recommendations are. We are generally positive across the sector, barring the odd one or two companies, right? The reason is, if you look at most of the listed players, be it a Prestige or a Shobha in Bangalore, be it a Lodha, a Godrej, or even an Oberoi in Mumbai, be it a DLF in NCR. Most of these companies, by their sheer presence, are amongst the largest players in their respective micro markets. And it's hard to tell who's going to capitalize on the increased sort of market share opportunity, like I said. But needless to say, the large players which continue to demonstrate sales, have access to capital, have the consumer trust with him, will benefit. And ironically, most of those happen to be listed players, right? So most of the listed players are in a good space. And the point that I make is, the underlying sector may not be doing as well as the BSE Realty Index probably suggests. So the sector is not going 2x or 50% growth. It will have a more moderated growth. It may be in a good spot, but it's the individual organized players which will do much better within that broader sort of sectoral theme. And therefore, it makes even more sense. Stocks have run up. It's harder to find value. But from, let's say, 6-9 months ago, where most of these were being valued as value stocks, where are the cash flows going to come through?
Yeah.
Today, they move to growth stocks, essentially. The question that one needs to answer today is not how much value is there on the table, but how much can these companies grow their sales? And that's the question that the market's looking to answer. And given that, each of these players, if one looks at on a pan-India basis, their market shares, you're talking about low single digits. So the headroom for growth through market share gains is pretty large, even though the underlying sector may not have sort of, strong double-digit sort of sales. But the individual players can have a lot more headroom to grow their market share and therefore grow their sales.
Um, just before I come to my final question about whether there are some special situation companies as well, because I mean, for example, Murtuza, I don't know if you can comment and if you have coverage, but there is a lot of opinion out there on social media about, say, for example, a company like Embassy, which eventually will take in India Bulls, and how, oh, there is not correct valuation out there and all of that. But before I come to that, Murtuza, I just have one long-term question, because you look at cycles so well within this and the other themes that you've tracked in the past or currently track as well. Is it possible that if somebody chooses the right real estate company to bet on and rides and stays on through this upcycle for however long it may last, then the gains could be multifold? But the reason I'm asking this to you is because typically at times when you enter a business or enter a stock at peak valuations, then even if there is growth, the growth in your returns isn't that much.
Yeah.
So is it possible in real estate that the converse might happen, that you might still make multifold growth if you stay for a longer period of time?
So given the opportunity size, like I said, is very large, and we're looking at, single digit market share, again, it's hard to pinpoint which are the companies which will sort of gain this. And so our recommendation has been more a basket approach as opposed to a company approach. Like I said, besides how much market share gains, the other question that we try to sort of address is which is the management which is going to capitalize on the opportunity. The opportunity is out there, and that's not a mathematical question. That's not, it's more qualitative, right? And it's easier sort of said than done. And which is why our approach has been, okay, go with the leaders, bank with a basket, right? And hopefully at least 3 out of 5 or 2 out of 5 will do fantastically well, even if the others don't do as well. And that's really been our approach over the last 6-9 months, to look at a basket. When we advise global investors, obviously sizes, market cap, liquidity, a lot of those things come into play. One of the challenges that you have is, even with the kind of stock rally that you've had, the sector is still small and under-owned from a size perspective, right? So a lot of global investors, a lot of institutional investors find it challenging to invest in companies of certain size. And so there is a tendency to sort of gravitate towards the larger versus the smaller. But that's not to say the small can't become large, given the opportunity that we're looking at.
Okay. Would you bet on that more? The smaller is becoming large?
My approach has been more a basket.
Basket, yeah. No, sure. And again, Murtuza, I didn't want you to spell out names, so I hope I didn't come across that way. Now, again, my final question then, Murtuza, and thank you for that detailed explanation. And viewers, I think it might help to look at this from that perspective. My final question is, are there these special situations existing? Again, I do not want you to tell us whether X or Y or Z company is a recommendation or is a buy at this price, but just wanting to understand from you, how do you look at those special situations?
Let me qualify that by saying we do not have coverage from some of those companies, which will be sort of the new special situations. But let me put it this way, there are a lot of corporates who also understand the underlying trends which are at play, and having a large corporate identity, access to capital and consumer trust helps you gain market share in the new real estate world. So without putting a name to it, there are at least a handful of companies which are trying to re-energize, refocus on real estate as a vertical by banking on their otherwise larger sort of group presence. And it helps because execution capabilities are present across the length and breadth of the company. A consumer brand with a brand recall is there, and access to capital is not a challenge. 3 of these which are key ingredients to be able to deliver. And so if a large corporate comes with a renewed focus on the vertical, those are situations definitely worth looking at. It obviously helps to be riding on the existing players, But if someone's able to convert from, not being in the radar of conventional real estate players to having made the cut, obviously the gains would to that extent be disproportionate. You're on mute, Neeraj.
No, I'm not on mute now. Murtuza, thank you so much for taking the time out and speaking to us today. Really appreciate your time and look forward to talking to you more often.
Thank you. Thank you,
And
Neeraj.
viewers, thanks for tuning in to this edition of The Talking Point.